Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really glad to have Michael Oliver with me today to take a look at what might be coming our way in 2018. Thank you for joining me today, Michael.
Oh, good to be back.
You know, it's Michael. It's OliverMSA.com, folks. OliverMSA.com. Well, Michael, you obviously feel we are on the precipice of some very big changes in the markets as we move into this new year, because on December 31st, you stated the following to your subscribers, and I quote, MSA suggests that the 2018 gold report sent out on December 18th, and this report on equities, as well as 3 other 2018 reports to be issued in the next 48 hours, might be best printed and filed by our subscribers. These are big number reports with large implications. Well, for the sake of time, I'm going to just simply turn you loose and let you talk about the major markets that you talked about, that you sent out these special reports to: gold, stocks, foreign exchange, commodities, and government debt. Go ahead.
Well, I think the big moves this year in terms of impact are going to be, I think you take the stock market and put it to the side. I think it's relatively small compared to the debt markets and the foreign exchange markets, and I argued the foreign exchange markets got into gear last May when the dollar broke down, and that's going to continue probably for a couple of years. I think we're our third massive down wave in the dollar, commencing from the 1984 peak. I think we started our third wave down, and it'll probably last a couple of years, and I'm not sure how deep it's going to go, but it's not going to be trivial. Now, that's one factor that's moving. The debt markets, and I'm speaking now not of high yield or junk bonds, I'm talking about U.S., German, Japanese bonds. They're on the precipice, technically speaking, with our momentum work, a long-term momentum work, not what's going to happen the next 3 weeks, of a major breakdown, meaning a rise in yields, regardless of the intentions or the policy goals of Draghi or the BOJ or the Federal Reserve. That will be sparked in part, it's hard to say which is going to lead which, but probably the commodity explosion that I think we're about to have will shake people, and it will shake the bond markets, and will certainly take away one of the lines of defense used by the central banks to continue their policies, namely inflation will be back. I think the grains have the greatest potential for a rapid, large double-digit % gain this year. Other markets like natural gas, which has not been doing much, has been very quiet all last year, I think it has the potential to go up at least 50% rapidly. Now, that when you look at a chart and you're talking about a commodity that's $3 going to $4.50, well, so what? You know, historically, that's a 50% move.
Yeah.
Uranium. I think uranium and uranium stocks could take off. I think gold is doing quite well. It's just short of 1320 right now. You get much over 1350, and I think they're going to light the thing up. Silver. Silver has been a relative shy puppy to gold lately, but I think it's going to come to life more so than gold. All it has to do is, well, let me put it this way. December made a low and made a high and closed on the high. If you take December's price range in silver and add even less than that amount to where we are now, you're going to blow silver out through a triple top on an annual momentum chart, which is a very explosive breakout. That level's around 1850 where the breakout occurs. But I see a lot of very big structures pending. Markets are moving toward them, and they're not particularly visible to a price chart analyst. In other words, when you quickly glance at any given chart of these various markets I'm talking about, there's nothing that you see that looks dangerous or positive. We're not near anything. But when you look at the momentum charts, they're huffing and puffing at starting gates. And again, forget the stock market. It's not an instigator. It's going to be a follower. So I think I would focus on the bond markets, the 3 that I mentioned, and our subscribers are provided with specific numbers to look at, and the numbers are very close. I'd look at the grains, because I think food commodities could really gain headlines this year. You have to recall the last 2 years, they've been, actually more than that, 3 or 4 years, they've been just laying on their backs at low levels.
Right.
Theoretical, I call it theoretical zero. In other words, a commodity is not going to go to zero. Okay, that doesn't happen. So when a commodity market drops and goes dead, quiet, at a given level for enough time, you have to assume that that's effectively its theoretical zero. If you look at a corn, wheat, or soybean chart, that's what you've had for about 3 or 4 years. And I think they're ready to come to life. And
right.
the first up move could be of the quality of 30 to 40% rapidly.
Yeah.
So anyway,
yeah, I know the commodities. You've been talking about the commodities and especially the soft commodities as your favorite section of the commodity sector, and one of the ways you like to play that is MOO, the ETF MOO, which I guess is a combination of implements of farm machinery and things like that in there too.
And fertilizer companies. So the MOO is actually we put out a buy signal in January at the same time we said buy the emerging markets. And MOO has easily matched the S&P, but the EEM has almost doubled. The emerging market ETF almost doubled what the S&P did last year, and yet nobody's cheering it. They're all cheering the S&P, but the real gainers were the commodity-related symbols. Now, not the ETFs that are directly tied to commodities. Those have not performed well because they're waiting on the commodity move itself.
Yeah.
But the MOO is comprised of industrial companies that service the agricultural industry, whether they make equipment or chemicals or whatever. Things like Monsanto and Mosaic and so forth, and potash. Mm-hmm. And that MOO has done very well. And I think particularly the fertilizer stocks. And if you go back, I don't know, what was it, about 10 years ago, that was a hot area to be in. I mean, It was the talk of Wall Street. Those stocks are coming up off the floor now. And they've got a lot of room to go, and I think they will. And I think they will definitely move with the grains. When the grains start, those investors are going to turn their heads and start looking at the fertilizer companies again. As boring as that may seem.
yeah, that's very interesting. Well, there's a stock that I cover in my newsletter called Ariane Phosphate that has a project that is just a world-class project that nobody's paying attention to, and it's one that I really think people ought to be paying attention to, especially given your views on the soft commodities. Well, Michael, I noticed that I think it was Barron's last weekend started talking about inflation, and of course most people talk about inflation not in terms of Austrian economics, and you and I would agree there's been plenty of inflation. It's gone into the bond markets and the stock markets, but now indeed there seems to be growing concern among the establishment that we're heading into some sort of what the government calls inflation. That would be the cost of living and the items that go into that. So commodities, food, and so on and so forth. Yeah, this is a real big concern, I think, going forward this year, Michael. If we start seeing major amounts of inflation, what's the Fed to do? I mean, it is
because they have to raise rates. Then their excuse for not raising aggressively is gone. Plus, the main thing is not the Fed, I think, so much as it's Draghi and the BOJ. Because they've been the most egregious central banks in the world. The Fed has been aggressive as it's ever been. There's no question about that. But compared to the ECB and the BOJ, the Fed is almost pale in its amount of aggressiveness and intervention compared to those two. And if Draghi gets faced with 2 and 3 and 4% inflation, all of a sudden, smacking him in the face with food prices and so forth, he's out of excuses. To continue the policy that he's maintained, because that's one of his rails that he's used to rely on, to say, well, we have to stimulate inflation. And, well, you got it. And once you get it, what are you going to do? Then the BOJ is going to be faced with that, too. And, of course, they're a major owner of not only the bond market over there, but the stock market.
Yep.
So it's going to be very interesting to see what happens when Mother Nature comes into play here. I'm talking about the forces of markets overturning policies that have been stretched too long and too far by central banks. And I think the commodities, the food price commodities especially, are going to upset the apple cart. Also, I was looking at the other day on the news, of course, the situation in Iran. One of the stories is that, well, it's food prices and stuff like that. Well, what happens globally when food prices really start to go up to unstable countries like that, particularly an oil producer?
Right.
It'll make the headlines interesting as well. So these are big events, and they're going to have a lot of wave effects, not just in markets, but politically and so forth. So it's going to be a fun year.
Yeah, hostility in that part of the world, in the Gulf over there, the Straits of Hormuz or whatever it's called there, I forget the name. Some energy supply coming off the market, and that, of course, also impacts fertilizer prices, too. So, yes, I think it is. I just have to recall with a minute left or so, you talked about the Judas goat last year, the idea that interest rates were going up because, everything was really good, supposedly. The economy was getting stronger and everything, and so, yeah, interest rates were going up, but for all of the good reasons. But now, if we start to get the bad reasons, namely the cost of everything, boy, that's not going to be very good. I think it's. Let me ask you, Michael, in terms of the gold price. Then, what you say around 340 or so is what you're looking for to spring it loose?
1350 is
1350.
1350 is a level that's obvious on price charts.
Yeah,
and I think there's a certain point in trend change when you can legitimately start to look at price action for trend change signals. Normally, momentum will break out well ahead of any price chart breakout. But when you look at a price chart of gold going back 3, 4, 5 years, you'll see basing action with a line across most of the highs, monthly or weekly price chart, going back to 2013, such that if you get up around 1350 again and close a week or a month up there, you're breaking out of a big price base. Now, that's $200 plus above where momentum already broke out in February of 2016 at a price of $1140. But still, I think it's a legitimate indicator because momentum is already stronger than price still. Therefore, if price breaks out, I tend to trust the price breakout. And I think that's when much of the public is going to finally wake up and say, well, this really is going up.
Yeah.
It's debatable among the public as to whether it is or isn't, but I think that level will turn the tide in sentiment.
Okay. All right. It won't be just the momentum people saying buy gold, but the
price people,
general public, and then we could really see something exciting. Well, it seems to be shaping up as a very interesting year, Michael. I want to thank you very much for passing along your insights. Always a pleasure to have you with me, and I mean, because you're just right so often. I mean, if you were 50-50 flip a coin type of guy, I would say, Oliver, maybe, well, okay, but no. You've been so right so much of the time, and I want to thank you for sharing your time with us. And we'll look to do it again next week if you're available. Thank you, Michael.
Thanks, Jay. Talk to you later.
All right.
Bye.